When you open Instagram, TikTok, or YouTube Shorts, you almost certainly come across videos like this. Someone made money on stocks, others made a 20 times return on crypto, and someone used AI to invest for them. And at some point, it creates the feeling that everyone around you is already making money from investing except you. It may feel that way, but that's not true. Around the world, roughly 7% of adults actually hold more than $1,000 in investments. So investing may look like a massive trend online, but in real life, most people either don't invest at all or simply don't know where to start. That is exactly why I made this guide. Over the next 30 minutes, I will give you a complete beginner's guide to investing from scratch. You will learn what the stock market is, what you can invest in, why so many people invest in the S&P 500, and how not to turn investing into gambling. By the end of this video, you will understand how to make your first investment and follow the strategies of the most famous investors in the world, like Warren Buffett, Ray Dalio, and even Nancy Pelosi, whose trades are constantly discussed in the media. Like any good video, I will start with a plan. First, we will break down what the stock market actually is, how it works, and why you should invest in it instead of just keeping your money in the bank. Then we will talk about how much you actually need to invest in order to eventually receive noticeable passive income from it. After that, we will break down how to properly distribute your portfolio and what strategies long-term investors use. And at the end of the video, I will show you a full demonstration, how to open an account, what tools exist for this, and how to make your first investment. So let's go. When we hear stock market, something from movies about Wall Street often appears in our head. Huge offices, endless phone calls, people in suits, tons of papers, and brokers. In short, the typical atmosphere from the movie The Wolf of Wall Street. From the outside, it seems like this is a place only for people who constantly read company reports from morning until night, bankers or traders. That may have been true before, but progress does not stand still, and now anyone can buy stocks. With the development of technology, the stock market has turned into a marketplace. Only instead of clothes, electronics, or home goods, shares of companies are sold there. These shares are called stocks, or shares. When you buy a share of Apple, Nvidia, Tesla, or any other company, you are buying a small part of a real business. If the business grows and makes more money, the stock also grows, and you earn together with it. If the company loses money and loses to competitors, the value of the stock falls. For example, if you have the gift of foresight or strong analytical abilities and you bought Nvidia at the end of 2022, congratulations. You got into one of the strongest market trends of recent years. Nvidia became one of the main beneficiaries of the artificial intelligence race because everyone needs chips, servers, and hardware for AI infrastructure. According to market estimates, Nvidia stock grew by more than 1,100% between the end of 2022 and 2025. But if, for example, you bought Intel, the picture looks worse. After a sharp peak, the chart went down, and with the current competition, it does not look like it will sharply recover. And companies with losses are actually the majority. So why take the risk and buy these stocks? The main reason is inflation. Inflation is when prices rise, and for the same money, you can buy fewer goods and services. Imagine you have $10,000. Today, you can buy this kind of car with it. You leave the money in your account for 10 years. You want to buy the same car, but now it already costs $20,000, and all that is available to you for that amount is this kind of car. Of course, you receive your 0.38% annual interest, but it does not even come close to covering how fast inflation eats your money. Let's say you have $10,000. You put it in the bank and receive $38 every year. At the same time, average inflation is 2 to 3% annually. This means you earn $38, while inflation eats around $300. That is exactly why it is so important to invest, so you do not lose your money. And if buying shares of one company is risky, then buying an index has already been giving around 10% annual interest for 70 years. Oh yes, an index is a set of companies collected together according to certain rules. The most famous one in the world is the S&P 500. It includes 500 leading American companies. The index itself cannot be bought because it is just a chart that is built according to a formula. But you can buy a fund that owns this index. There are many of them. By the way, you can see some of them on the screen. So when people say, I bought the S&P 500, most often they mean that they bought one of these funds. The main advantage of the index is risk diversification. While one company may fall, another may rise. Moreover, companies in the index cannot fall to zero forever inside it. If a company starts performing badly, loses significance, or stops meeting the criteria of the index, over time it can be removed from the S&P 500, and its place will be taken by another, stronger, and more profitable company. That is why you will always own a part of the 500 toughest corporations of the strongest economy in the world, and they clearly understand something about finance. Let's look at how profitable it is to hold and buy the S&P 500. Starting from 1957, the index has shown an average return of 8 to 12%. Of course, this chart is not a straight line up. There were painful crashes: the dot-com crash in 2000, the 2008 financial crisis, and COVID. These are the points where most beginners make the biggest mistake. They panic and sell at the worst possible moment. But historically, the market recovered from these crashes, and over the long term, the S&P 500 still averaged around 10% per year. So for our example, let's take that 10% return and compare it with inflation. From our $10,000, we will get $1,000 as a profit, and around $30 will be eaten by inflation, so we get plus $700 every year. That is around $700 in real profit every year. And if you do not withdraw that money and leave your $10,000 in the S&P 500, then after 2 years, you will already have about $12,000, and after 10 years, around $26,000. This is called compound interest. In many of his interviews, Warren Buffett recommended exactly this combination: buy the S&P 500 and use the power of compound interest. So what is compound interest? Imagine that it's winter and you go to the mountains to ski. You climb up the hill, and at some point, you decide to make a huge snowball. At the beginning, it is hard. The snowball is small, it barely moves, and you have to put in a lot of effort just to make it roll. But the bigger the snowball gets, the more snow it collects with every turn. And at some point, it starts rolling faster and faster almost on its own. You still gave it the initial push, but now the size of the snowball is doing most of the work for you. Compound interest works almost the same way. In the early years, your contributions matter most. Later, investment returns start generating their own returns, and then those returns start generating even more returns. There is a simple mathematical formula. The longer you keep investing, the more money comes back to you every year. The key word is longer, not more. So we need to figure out how much you should invest and for how long. To calculate this, here is a website called a compound interest calculator. It shows you how your money can grow over time through investing. Let's say you start with a $0 initial investment. You contribute $500 every month into the S&P 500, and we're assuming you're going to earn the historical average annual return of about 10%. After 10 years of following this strategy, your investment portfolio would grow to almost $100,000. During that time, you would have contributed $60,000 of your own money, and about $35,000 would come from investment gains. Right now, this chart doesn't look too exciting. Sure, you've had some growth, but nothing spectacular. Just wait and see what happens as we push the timeline out further. Now let's look at 20 years. Most people would think this number would simply double to around $200,000, but this is where the real magic of compound interest starts to happen. After running the calculation, we can see that the portfolio has grown to almost $350,000. That's a lot more than just double the previous result. Over those 20 years, you would have contributed $120,000 of your own money, while your investment gains would have grown to around $210,000 to $220,000. If you look at the red line, you can see that it starts accelerating faster and faster. Every single year, the market is generating more returns for you. At this point, your portfolio has less and less to do with the amount you're contributing each month, and more to do with the momentum that has been built through decades of investing. Now, I want to show you how long it would take to become a millionaire. I already calculated it in advance. The answer is just 31 years. If we change the timeline to 31 years and click Calculate, your investment account would now be worth $1.09 million. The red line just keeps accelerating at a faster and faster rate. By that point, you would have contributed about $186,000 of your own money, while the stock market would have generated just over $900,000 in investment gains. The strategy is to pick an index fund, set up automatic monthly contributions, and leave it alone. Sometimes the market can rise by 13%, and sometimes it can fall by 15%. The most important thing is not to sell during a market drop. That sounds obvious, but it is not that simple. Imagine you have $100. The market rises by 20%, so your investment grows to $120. Then, the market falls by 20%. It may seem like you should be back at $100, but you are not. You are left with only $96. This happens because the increase and the decrease are calculated from different amounts. The first 20% is calculated from $100, while the second 20% is calculated from $120. A market drop does not necessarily mean that your money is gone forever. As long as you do not sell, your investment still has a chance to recover when the market rises again. But if you sell during a major drop, you lock in the loss and may miss the recovery. After a decline, the market always needs a larger percentage gain to return to its previous level. After a 20% drop, it needs to rise by 25%. After a 50% drop, it needs to rise by 100%. That is why large market drops are so dangerous. The deeper the fall, the more the market needs to grow to fully recover. Let's say you have finally managed to build up a certain amount of money. Now you need to understand how much you actually need to live on passive income and stop working. This is where the 3% to 4% rule comes in. Once you have built a large enough portfolio, many financial experts suggest withdrawing around 3% to 4% of its total value per year. This does not mean taking out 3% to 4% every month. It means withdrawing around 4% over the entire year. Of course, the exact number depends on how much money you have saved, how much income you need, or how your portfolio performs. But as a simple estimate, many people use around 4%. There is an easy formula that helps you calculate the portfolio you need. Take the amount of money you want to receive each month and multiply it by 300 or 400, and you will get how much money you need to get passive income. The result is the approximate size your investment portfolio needs to reach. All of these formulas may sound a bit abstract, so let's look at a real example. Let's say you've managed to save up $100,000. Using the 4% rule, you can safely withdraw about $333 per month. If you keep withdrawing that amount while your portfolio earns an average annual return of 10%, your money will continue to grow, just at a slower pace. After about 10 years, your portfolio would be worth roughly $178,000. After 30 years, it would grow to a little over $500,000. Now compare that to what happens if you never withdraw anything. After 10 years, your portfolio would already be worth about $250,000. After 30 years, it would reach roughly $1.75 million. That is the power of compound interest. Even relatively small withdrawals can make a huge difference over several decades, but most people want both. They want their portfolio to keep growing while also generating enough passive income to actually live on. After all, $333 a month is nice, but it's probably not enough to retire on. So let's see how much money you would actually need. First, let's pick another rate. 4% is too much to keep capital growth fast, so we pick a 2% withdrawal rate. At that level, your portfolio can continue growing at almost the same pace, assuming an average annual return of around 10%. With a 2% withdrawal rate, to receive $1,000 per month, you would need about $600,000. For $2,000 per month, about $1.2 million. And for $3,000 per month, about $1.8 million. Every additional $1,000 of monthly passive income requires roughly another $600,000 in your portfolio. Now let's compare that to the 4% rule. You can withdraw twice as much money, but your portfolio will grow more slowly over time. For example, if your goal is to receive $10,000 per month while keeping your portfolio growing as fast as possible, you would need around $6 million. If you're comfortable with a slower growth rate and use the 4% rule instead, you would need about $3 million. Those are definitely not small numbers, and building a portfolio like that takes years, if not decades. But once you finally reach that point, you can quit your job and spend your days doing whatever you enjoy, maybe even playing GTA 6. And all of this can be achieved by simply investing in an S&P 500 index fund and leaving it alone. But there are far more interesting strategies, and I am going to break them down next. But before that, I need to explain one extremely important rule. Never invest money that you may be forced to sell.
If you don't believe me, here's what Warren Buffett and Charlie Munger said. Both of us believe it is insane to risk what you have and need in order to obtain what you don't need. It does not matter how confident you are about Apple, Nvidia, Bitcoin, or the S&P 500. If the money is intended for rent, medical expenses, education, an upcoming tax payment, or an emergency, it should not depend on the short-term direction of the stock market. The market does not know when your bills are due. It can fall during the same month that you lose your job or during the same week that your car breaks down. That is why the first step in investing is not finding the best stock. It is creating financial stability and a cash pillow. This cash may look unproductive, but it saves you from a lot of trouble. When you have your emergency fund, you can finally move on to building the investment portfolio. One of the simplest and most effective strategies for beginners is called the 3-fund portfolio. You buy 3 ETFs. One covers the US stock market, one covers international stocks, and the last one covers bonds. This is one of the most common strategies beginners use. It works because it's low cost, diversified, and built to handle almost any market, whether stocks are booming or crashing. You don't need to pick winning companies or time the market. You just own a small piece of thousands of businesses around the world, with bonds mixed in to smooth out the ride. A common split is 60% in US stocks, 30% in international stocks, and 10% in bonds. That mix gives you strong growth from the US, extra diversification from international markets, and some stability from bonds. The 3-fund portfolio has stood the test of time. It works, and a lot of people use it. But we aren't looking only for stable returns. We are looking for the strategies with the biggest returns. To find it, I picked 3 of the most famous investors from the last 20 years and broke down exactly where they invest and what they recommend. I chose people from different backgrounds with completely different ways of thinking to show you just how many paths there are to building real wealth. The first strategy belongs to someone you've probably already heard of. His name is Warren Buffett. You probably see his recommendations for ordinary investors, like invest in the S&P 500 or buy bonds. But there is a huge difference between the portfolio Buffett recommends to an ordinary investor and the portfolio owned by Berkshire Hathaway. In his 2013 letter to Berkshire shareholders, Buffett described instructions for a trust that would benefit his wife. He instructed the trustee to place 10% in short-term government bonds and 90% in a very low-cost S&P 500 index fund. His reasoning was that a non-professional investor could achieve strong long-term results through broad diversification, extremely low fees, and patience without attempting to identify the next extraordinary company. But Berkshire Hathaway does not hold 90% of its money in an S&P 500 fund. So what does Berkshire actually own today? Right now, Berkshire is sitting on about $397 billion in cash and short-term treasury bills. That's the largest cash pile in the company's history. Then there's the stock portfolio, worth about $263 billion. 5 companies still make up more than 2/3 of it. Apple leads at 22%, followed by American Express at 17%, Coca-Cola at 12%, Bank of America at 10%, and Chevron at 7%. This quarter, Berkshire made some big moves too. It more than tripled its stake in Alphabet, the company behind Google. It trimmed Chevron, and it walked away completely from Amazon, Domino's, and United Health, while picking up new positions in Chubb and the New York Times. Outside of stocks and cash, there's a small slice of longer-term bonds too, usually $15 to $25 billion. Tiny compared to everything else. And then there's the part that never shows up in any stock chart. Berkshire owns entire businesses outright. Insurance companies like Geico, the BNSF Railroad, a big energy and utilities business. And this quarter, it added a chemical manufacturer called OxyChem for about $9.5 billion. Those businesses are actually where most of Berkshire's real value comes from.
So basically, Warren Buffett's strategy is very simple. He buys companies that look like good businesses to him and holds them for decades. That's why his portfolio looks the way it does. He'd rather hold cash than buy something mediocre just to stay busy. And when he does buy, he goes big on a handful of companies instead of spreading thin across hundreds. As you can see from his portfolio, he doesn't hold any stocks of AI companies like Anthropic or ChatGPT. Because his strategy doesn't follow trends, it's about making money the simple way. Find a real, profitable company and hold it for as long as it keeps working. That's why his stocks are in giant, established names like American Express, Coca-Cola, and Bank of America. They're trusted, they've proven themselves over time, and they hold their value extremely well. So if you want to copy Buffett's strategy, look for long-term, solid companies and invest in them. The potential returns from these investments may not be very high, since you are investing in established companies that many people already trust and invest in. However, this strategy can help you save your capital and prevent inflation from eating away at your money. If you have already managed to accumulate a substantial amount of capital, this strategy can be very effective for you. The next guy in our list is one of the most famous investors in the world, Ray Dalio. Dalio founded Bridgewater Associates, which grew into the largest hedge fund on the planet. He spent decades studying how economies actually move through growth, recessions, and inflation, and wrote some of the most widely read books in finance along the way. But you may know him from this cool animated video on YouTube and this channel. His portfolio looks like this. 30% goes into stocks, 40% goes into long-term government bonds, 15% goes into medium-term bonds, and the last 15% is split evenly between gold and other commodities. I know what you're thinking. This portfolio looks boring, almost too safe for someone with decades of trading experience. Where's SpaceX, Nvidia, and AI companies? How does he make so much money while missing out on games like that? If you've ever caught yourself thinking this while looking at Tesla's or SpaceX's explosive gains, congratulations, you've experienced what's known as FOMO. FOMO, or fear of missing out, is the feeling that everyone else is getting rich while you're being left behind, pushing you to invest simply because you don't want to miss the next big winner. And the whole point of Dalio's strategy is avoiding FOMO.
FOMO. Instead of chasing hype, he is buying something more stable like gold. It hasn't dividends or interest. But unlike Nvidia, it doesn't depend on one company, one CEO, one industry, or one government. For centuries, gold has held its value even while stock markets were collapsing. Another 40% in bonds builds around his idea that the economy moves in cycles, recessions roughly every 5 to 8 years, and the next one is always coming. We just don't know exactly when. When it hits, central banks cut rates, and existing bonds jump in value, often gaining more than they ever lost in the good years before it. Dalio actually laid this whole theory out himself in a video called How the Economic Machine Works. 30 minutes, tens of millions of views. Genuinely worth watching if you want the deep version of this. As a Buffett, he also invests in something stable and long-term. But when Buffett bets on individual companies, he personally researches and believes in them. Dalio does the opposite. He tries to avoid depending on any single company at all and builds around instruments tied to bigger economic forces instead. However, both of them are great investors who know how to preserve and grow their wealth. There is only one problem. They are human, and humans can make mistakes. Our next strategy, however, does not depend on any individual. I am talking about AI. It is everywhere right now. You've probably seen tons of videos on Instagram and TikTok. People say they're using AI to trade and make millions, just lying on the couch while the computer does all the work. It sounds amazing. But here's the truth. Those people aren't making money from AI. They're making money because you click their link. Still, they're not completely making it up. A system like that really can work. In fact, one already has for almost 40 years. It's called Aladdin. BlackRock built Aladdin back in 1988. From day one, the whole company was built around one thing: managing risk, not picking stocks. By the year 2000, Aladdin became its own product. Today, it helps manage over $21 trillion. And that's not just BlackRock's own money. Hundreds of other banks and big funds around the world use this same system too.
Every single day, it runs thousands of what-if tests. What if interest rates jump? What if tech stocks crash 30% next month? It checks tons of situations, some of them oddly specific, right down to the odds that a kid you once babysat grows up to play against your country in a World Cup final. The system looks at real numbers from the past to answer these questions, and it shows exactly which part of your money would lose the most in each case. Unlike those TikTok videos, this thing has a real history. It's survived real crashes. It would be amazing to use Aladdin ourselves, but let's be honest, we're just regular people, not a big bank. We can't get direct access. What we can do is copy the ideas that BlackRock's own experts share in public. Here's their advice for 2026 in simple terms. Put some money on AI using a fund called BAI. Spread the rest across a few different types of strong companies using a fund called DYNF. And instead of long bonds, hold short ones. Skip TLT. Use SHY instead, or an even shorter one called SGOV. They also have their own version of the S&P 500. In the US, it's called IVV. But if you don't live in the US, you don't want that one. You want its twin, called CSPX. Same S&P 500, just built to follow European rules, so people outside the US can legally buy it too. This fund is huge, over 130 billion euros. But keep in mind that you still can't copy everything they do. Some of what they invest in, like private deals and hedge funds, just isn't open to regular people like us. But copying the public advice from one of the biggest, most successful funds in the world, that's already a smart move. Now it's time to stop talking and actually buy something. I want this part to work no matter where you're watching from. Some of you are in Europe, some are in Asia, and the usual apps like Robinhood or M1 don't even work there. So I found something that works anywhere in the world. I'll show you that first. Then I'll show US viewers how to buy the S&P 500 too. Let's start outside the US. Say you want to buy something like SpaceX without filling out a mountain of forms. There's an app for that called Trust Wallet. It just added a way to buy stocks. Since it started out as a crypto wallet, you can pay with crypto or with a bank card. Just go to the App Store, download it, and sign up. It only takes a minute. I already bought $100 of Nvidia through it. I lost $4. That's not advice to copy me. I only did it to show you. To buy a stock, open your wallet. Find the stock section in the menu. You'll see a list of stocks you can buy. Right now, this feature is brand new, only about a month old. There's no S&P 500 fund on there yet, just single stocks. But give it a bit more time, and that will probably show up too. Let's say you want to buy Microsoft. First, you need to add money to your account. You can do that two ways. One, through crypto, using something called BNB Smart Chain or BEP20. Just be careful to pick the right network. Two, straight through Apple Pay. That way costs a small fee, but it's simple and it works. The second option is only for people in the US. It's called Robinhood. It's easy to use and it keeps adding new features. You can buy almost anything on it, from bonds to full index funds. To get started, go to the App Store and download it. Then you'll need to verify your identity. They'll ask for your home address and your tax number, your SSN. After that, you'll answer a few quick questions about your goals. Then you're in. Just add money using a card. There's a search bar at the top. Type in what you want, like bonds, and it shows you your options. Want the S&P
500, you need to buy a fund that copies it, like one from Vanguard. Crypto is in there too, so you can invest in almost anything from one single app. Want a full walkthrough of everything Robinhood can do? Drop a comment and let me know. Now you know how to open an account, so before you go do that, here's a quick refresher. Ranked from calmest to most aggressive. Ray Dalio's all-weather is the calmest, spread across stocks, bonds, gold, and commodities, so no single bad year hits too hard. The 3-fund portfolio is your steady baseline, broadly diversified, low effort, built to survive almost anything. Buffett's approach flips that, concentrated in a handful of businesses he trusts, bigger potential reward, but real risk if one of them stumbles. And the BlackRock-inspired portfolio is the most aggressive, nearly 90% in stocks with a direct AI bet. Remember the rule, higher potential return, higher risk. Nothing here is free money, so pick whichever one actually matches your comfort level, not the one with the biggest numbers on screen. And never invest money you might need soon.